I'm Ashton Addison from Blockwest Capital for Investment Pitch Media. And today on the Crypto Coin Show, we have back with us Jason Blick, the CEO of EQIBank. Jason, welcome back to the show, and it is great to see you again.
Oh, it's great to be back, Ashton, and looking forward to this podcast.
Likewise, so much has happened in the banking sector since we've last spoken, and in the blockchain sector as well, and the merging of those two. And I'm excited to dive into the insights on what EQIBank is doing with Neobanking and the huge allotment of products that you and your team are building out and are servicing around the world as well. But for those who didn't see our first interview, I'd first like to just get a little refresher on a bit on yourself and your history in banking and blockchain, sort of how that led to EQIBank.
Yes, certainly. So EQIBank was formed in 2015, and we've gone on to become one of the largest global digital banks. So we service the needs of customers in over 180 countries around the world, and especially the digital asset and crypto community. So the team itself had been working with major international banks for more than a combined 100 years. So we were very conscious of the problems that banks have been creating for their clients for a very long time. Mm-hmm. And none of these things will surprise you. Clients are looking for better and quicker service, cheaper rates, more expansive product sets, and a complete ecosystem. So they don't need to bounce from one provider to another provider in order to get their daily banking or trading needs met. So we, in 2015, created EQIBank, and we have gone on to become one of the leading digital banks over the last 8 years now.
That's amazing. And at the beginning of this year in 2023, I heard a lot in the news around the banking sector in America, and it wasn't looking good. But it seems that the news sort of disappeared around that. I'm guessing that the solutions haven't been, all the problems haven't been solved. But it's sort of not in the news. There's probably something to that. But I'm sure you sort of have a handle on, what's the banking sector look like in the U.S. right now, and its transition to digital banking or crypto banking, or even moving outside of the U.S.
Well, it's a great question. There's no question that a whole plethora of clients were adversely impacted as a result of closures and mergers in the banking community in the US this year and towards the end of last year. So there were some major brands that went out of business: Silvergate, Sovereign, Prime Trust, Silicon Valley, Bank Fidor. It's a long list. Now, for our industry, the problem that immediately hit the clients was the fact that there were so few other banks, good banks, that were prepared to support the digital asset business. And the rise of Silvergate, Sovereign, Signature was tremendous. They did a great deal for the industry. However, they were perceived to have taken risks that adversely impacted their balance sheet, and the end result is quite well known. So now what we're starting to see is the US regulators and the Fed specifically really trying to get a handle on how they can support innovation but mitigate risk. The last thing they need is having to restructure banks and protect the ongoing security of the US banking system against relatively small industries such as crypto and digital assets. So they are making some progress, but it's fair to say that the capital flight from the US continues, and it's continuing unabated. So we're seeing major exits of US entities and global entities that were previously happy and really were perhaps getting their needs met by the US banking majors, and are now moving to European offshore banks and Asian banks that can provide ongoing facilities. Obviously, however, we are still all reliant upon US correspondent banks. So whilst the primary banks may no longer be that friendly to digital assets in the vast majority of instances in the US, there is an ongoing reliance on the core Nostro facilities provided by correspondents. But what we have seen is a major inflow of the crypto and digital asset giants wanting to move offshore, obviously maintain accounts in USD, which accounts for about 90% of most settlement and transaction activity for crypto entities, but have it in a perhaps a more regulatory friendly environment, and a regulatory friendly environment that understands this industry. So there are always options. Other banks have stepped up and met the needs of the audience that was previously with those US giants. But it's an important lesson for us all, and we do need to be able to identify how a risk can impact a bank and then make an informed decision. We shouldn't always assume that every bank, just because they're a bank, is a safe bank and a stable bank.
Definitely. And I think a lot of people, most people, you don't really find out until it's too late, or I remember in around March of 2023, I recall it was 80 to 90% of the startups in San Francisco were all using this specific bank that was very catered to digital assets and innovative companies. And, they all woke up at 4 a.m. and realized that they couldn't pay their payrolls and it was too late. They didn't really have a banking alternative. And I know for some people, it's hard to switch banks when you're already sort of tied up in things. But I think it's of utmost importance now to understand diversification geographically, especially with regards to those startups in the States, that digital banking or global banking and offshore banking is actually a viable and potentially better alternative.
Yes, I mean, we live in a borderless world. We have done for a very long time. And a lot of people misunderstand what offshore banking actually is. Offshore banking is very simple. If I'm based in Canada, but my bank is in the United States, that's banking offshore. It's the bank is just in a different country to the one in which I am based or operating. So the differences between on and offshore banking have really become less significant over the course of the last 15 years or so. And we always advise clients to pick a healthy mix of both domestic banks for some operating needs, etc., on the ground things, and good, well-structured offshore banks that can provide global facilities. And you often find that global offshore banks are able to provide additional product sets, which may be a little bit harder for domestic entities, such as trading and custody, OTC for crypto, etc. There's often a bit more flexibility in terms of those product sets. But as always, irrespective of the business that you're in, diversifying and spreading your portfolio, spreading the risk, if you will, over a series of banks remains the most sensible thing to do. As many have found that were previously with one or two institutions in the US, once those institutions become compromised in some fashion or another, it can have a massive impact on your business. Funds can be frozen. There can be limits in terms of what you can withdraw. Ultimately, you're only protected up to $250,000. And whilst the chance of a macro failure is very low, because other banks are always encouraged to absorb those entities, there is still substantial disruption. And we have seen cases of clients nearly going out of business because of some of these delays. But thankfully, there are banks that are stepping up. Ourselves, along with a series of others, have been onboarding corporate clients from those US banks in as little as 2 or 3 days, and then meeting their ongoing needs. So there are solutions out there. It's just about carefully picking those that meet your needs.
Mm-hmm. That's great insights, Jason. And I think in the past, there was a painting of some kind of black mark of, offshore banking is bad, or, it's a gray zone. But I feel like that might have even been a marketing campaign by the people within the US themselves, trying to say, hey, banking inside the US is safe. Don't go elsewhere because it's not going to be as good as us. But I think nowadays it's really hard to determine if that's true or not. And do you have insights into, the growth of people moving offshore into perfectly legal, better alternatives than US banking?
Yes, of course. And you're absolutely right. Obviously, it's in the interest of every domestic regulator and every banking association in every country in the world to claim that their banking is the best. And we all understand the polarizing nature of that, but why it's happening. I would say, judging by our experience, that over 40% of the top 100 crypto entities and digital asset entities have looked to move banking outside of the US. And judging by the deposits we have received from the top exchanges in the world, plus the largest OTC providers, liquidity providers, market makers, wealth managers in the space, and funds, that continues unabated. And it's not just a matter of a risk factor for the bank itself or the underlying banks in US banks. It's also about the efficiency of the services that have been provided. We just saw another major US bank that's based in Europe pull out of crypto yesterday. So now they're going to stop and close accounts in the UK that relate to or have a large crypto component. And that is clearly a major blow to the industry and clearly a reflection of the fact that banks are still trying to find their comfort levels in this industry. So the first thing to ask any bank is, are you friendly to digital assets? Do you support the major digital asset clients across the world? And if so, can you talk about them? Some can, some can't, and quite understandably. But it's about looking at credit rating. It's about looking at speed of wires. It's about looking at asset base and their ecosystems, because what you tend to find is if there's a bank that's supporting, one or two of the top 5 exchanges, perhaps a couple of liquidity providers and what have you, the chances are they do have the skills and the wherewithal to provide you with the services that you need. But it can't just be obviously a digital asset bank, and that became quite popular over the period of the last 4 or 5 years or so. But you need a bank that has a nice basket of assets, public companies, funds, multinationals, and a variety of industries. And that's becoming easier to spot because the banks that are supporting our industry are becoming more willing to talk about it and more willing to differentiate themselves from those that are pulling back. But in that process, and in the process of looking to determine whether you are with a safe bank, or if you're looking at new banks, what do clients need to look for? Because this is often not talked about. We just assume that banks are safe, but you should always look at 3 core things. First of all, credit rating. What is their credit rating by any leading credit agency? And obviously, the higher the credit rating, the better. The big one, especially now, is capital adequacy ratios. So in the past, we have allowed, or we have watched, I should say, capital adequacy ratios for US and US banks, UK, US and European banks decline to anywhere between 8 to 13%. Now that presents a real risk for depositors in the event of a run on any bank at all. So sensible banks, prudent banks, are now increasing those capital adequacy ratios materially. Now, that's really hard for some of the big traditional banks because they have already made commitments to treasuries, they've already made commitments to loans, to mortgages, etc., which makes it hard for them to improve their credit rating and capital adequacy ratio in accordance with BIS standards. However, for new banks or those that perhaps are a bit more risk averse, you don't have those issues. So, for example, EQIBank has a capital adequacy ratio of 81%, which is around 9 to 10 times safer and better than the average US rate. And we're not alone in those very solid and stable numbers. There are other banks out there. So it's important to look, first of all, at the credit rating. Secondarily, do a really big deep dive into the capital adequacy ratio. If it's not a healthy number, if it's not a good number, choose an alternative provider. The third is the Texas ratio. And the Texas ratio is another way to determine the liabilities on the bank and their ability to be able to meet those liabilities. So those are the 3 ratios that people can and should look for. They can Google it online. They can see the entries and what they represent. But they're good, solid questions to ask any new potential bank. And the third part of this is differentiating. Make sure that you are using more than one corporate account or individual account. Make sure you're not reliant on just one institution because you never know what can happen. And in combination, you will then end up with a very, very safe portfolio, a very secure bank to work with, or banks as it may happen.
That's very great information. Thank you, Jason, for laying all that out. I'm going to make sure as we talk to a lot of tech startups, and it's like some people just don't know what are the questions to ask on what actually makes it safe. And I feel like the banking sector, they sort of make it, convoluted, and they just say, of course we're safe, we're a bank, just trust us with all the information and just give us your capital and we'll do the rest.
Well, you're right. I think fundamentally banking hasn't really evolved for 100 years. A lot of banks still maintain this slightly ego position of not really working for their client support, for their client satisfaction and what have you. We're quite blessed. We have a 4.6 trust score pilot, which is excellent. We have an 81% net promoter score. And there are other banks as well that are really going out of their way to meet the needs of their clients and adapting to becoming more proactive. We believe that banks are going to have to adopt more of a partnership approach to the way in which they support clients, getting a really good understanding of what the client is aspiring to do and support them with the product sets, even advertising, even joint ventures. All of these things are available if you have the willingness and the ear of your bank. And the bank is one that's really focused on being client friendly and not just sitting there waiting for deposits to roll in. But there are innovation banks now that are doing some very exciting things, for example, around banking as a service, embedded banking, banking as a platform. That's the next big thing for our industry. And it's something that EQIBank is really leading with. So we provide banking as a service to clients in over 180 countries, enabling them to provide banking to their client base in their brand. And that is where banking is going to go. We're not even going to be familiar with who we're actually banking with as more technology companies start to deliver embedded banking or banking as a service in their product sets, which is really, really exciting. And that's where we'll start to see enhanced customer satisfaction as technology groups who tend to understand client bases a little bit better are able to provide banking as part of their composite solution, but still maintain that really client-friendly partnership approach to client acquisition and maintenance.
Mm-hmm. Wow, that's very exciting. And with the banking issues that we saw, in the first 2 quarters of 2023, I know you mentioned that neobanking, digital banking has been growing over the last 4 to 5 years, but as I said, I think a lot of people, they don't know what the issue is until it's too late. But when something happens, things trigger in people's mind. I think a lot of those startups in San Francisco, the next day, they all of a sudden had a new vision towards digital banking. I'm curious on the growth rates for 2023 for EQIBank and for digital banking. And did you see, a spike in like startups and corporations that were like, hey, we need to start doing digital banking in offshore accounts?
Yeah, well, we saw 2 patterns of activity, which are continuing today. I think it's fair to say that entrepreneurs and innovators that were previously incorporating US entities and relying on US banking are now increasingly looking at overseas options as well. Mm-hmm. So that has been a major source of ongoing business and activity for us. But the major source has been the multinationals moving large deposits in their millions, hundreds of millions, and in some instances more. And that's because of those two tied risk factors. First of all, from a regulatory perspective, the US is making some great strides, but still has work to do about supporting our industry. And the banks themselves really don't know or understand the industry as well as perhaps they thought they did. And they are trying to get up to speed whilst at the same time liaising and trying to work with the regulator on something that is sustainable. As a result of that, what we've seen is major deposits and major business leave some of the big traditional banks and move to digital innovation banks. And digital banks are basically just exactly the same. There's 2 forms of banks in the world. There are those that hold deposit-taking licenses, like EQIBank and Wells Fargo and Chase. And there are those that are neobanks, and neobanks rely on somebody else's license, like Revolut and N26 in certain jurisdictions. So there is a big difference. We are a traditional bank. We hold our own licenses. We are a full deposit-taking institution, but we have product sets that other traditional banks are not providing. So, for example, our OTC for crypto enables clients to get in and out of any major crypto and have the cash in their account in around 15 minutes. And it's those services that are really also driving customer acquisition. So people are looking for a safe institution, and there's a major exit of deposits from the US in that regard, but they're also looking for an institution that can provide more services, so they don't have to work with one OTC provider, then go to an escrow agent, then go to an exchange, then talk to their liquidity provider, then talk to their bank. And obviously with that level of interaction, there's always the risk of one of the links being weak and fracturing the chain, resulting in usually delays for payment, but that in itself is a major disruption. So institutions are increasingly looking at ways where they can provide banking, trading, custody, lending, card services, wealth management, and banking as a service in one institution. And those are the ones to watch, including in that regard, EQIBank. So we expect the outflows to continue for the remainder of this year and probably up until the end of Q2. By Q2, we're expecting some further announcements regarding Fed's position on crypto. And then from Q3, we'll certainly hopefully see a more stabilizing position in the US. But by that point, all of these other opportunities will have been made available to clients. So clients are going to start looking more at working with banks in Europe, which is obviously offshore, ourselves, Asia, etc., just to get a more composite solution and to allow risk mitigation.
It's a very important point about OTC and just having a bunch of different services so that you don't have different risk factors from different parties that you're dealing with and potentially more delays. And I'm curious about the OTC with EQIBank. And, throughout the summer of 2023 so far, we've seen at least Bitcoin and the crypto markets fairly going sideways, not a lot of price action, but a lot of people that are just checking the chart, you can't tell how much OTC transactions are happening and how many large corporations are actually buying Bitcoin off the books or other digital assets. But the OTC providers do know. I'm curious if you have any insights into the growth of the OTC sector in EQIBank, and are there institutions that are buying Bitcoin at these low prices?
Yeah, we've operated our OTC desk now for several years, and it now contributes nearly 35% of our global revenue. It is a product that is in hot demand. So we provide, and so do a couple of other banks, we provide trading services for securities, bonds, treasuries, and crypto. Now, crypto is increasingly being used by our corporate clients, but in a very interesting way. What we're seeing is that major corporates and institutional players are using stablecoins as a way to settle everything from traditional vendor invoices or client payments through to complicated structures, including letters of credit. So that is an entirely new use case for stablecoins, which banks have a better picture of than perhaps anybody else, because obviously the creation of letters of credit, the creation of lending facilities around particular product sets has to involve, or usually involves, a bank. So we have found a huge increase in corporates using stablecoins as an alternative rail to SWIFT and SEPA. Our own OTC desk is up 280% year on year up until the end of August, and banking revenues for the digital asset community are up over 100% year on year. So the demand for OTC is definitely increasing, but interestingly enough, mainly with the stables so far as we're concerned. But the use case is increasing enormously, and we're really excited about supporting that. And a quick example is probably worthy of discussion. So if you have a couple of corporates that are requiring a letter of credit, or they need to settle an invoice, they can do it through SWIFT, and that may be T+1, T+2, so it can take 2 days, or depending on how exotic the jurisdiction is. We have clients in Botswana, we have clients in Sierra Leone, we have clients in Singapore and Japan and the UK and Australia. But it can be up to T+3 to T+4, depending on SWIFT. Now, stablecoins enable us to settle certain payments instantaneous, basically, and then do an OTC and have the US dollars, sterling, yen, whatever else it may be, in the client's account in about 15 minutes. And we think that's going to be a trend that will continue to be supported predominantly by banks, and that's why there is such a deep excitement by banks in terms of central bank digital currencies, but obviously awareness and an understanding, caution by major stablecoin groups across the entire world. But we believe that is interoperable. We believe that central bank digital currencies and stablecoins will be utilized by banks moving forward almost seamlessly, and we're delighted to be at the forefront of that.
Wow, that's super exciting. And I always laugh when I hear about the delays in that a lot of these banks are using the SWIFT system T plus so many days, when these stable coins, clearly you can settle things very quickly. And if you use the OTC, move into different currencies in minutes. It's just ridiculous how much better it is. So that's great to hear about the 280% growth in OTC. It sounds like these institutions are really noticing that, it's probably going to save them a lot of time and money. And you mentioned there about the CBDCs as well. I'm curious if you have any insights into that transition of, from using fiat currency to then using stable coins, but then also CBDCs come into play, and how will they be used in the same ways or in different ways through the digital banks as well?
That is a great question. Fundamentally, at the moment, what clients are all wanting, and clients have always wanted, is speed of delivery, speed of execution. To that end, EQIBank, for example, is rolling out instant settlement, and it's a facility that's available in other leading banks. That enables clients to seamlessly transfer money and receive money amongst themselves 24/7, 7 days a week in less than 10 seconds. That is a service that really is massively needed and encouraged by the major digital asset entities, exchanges, OTC desks, everybody that's involved in our space. So instant settlement is definitely critical, and EQIBank is really excited about our InstaClear program. Now, that goes hand in hand with other initiatives such as stablecoins and central bank digital currencies. So having a platform that enables clients to clear instantly within EQIBank provides that efficiency and security. But when it comes to external payments, obviously there are several options on rails today. We can use SWIFT, you can use Fast GDP Pay, you can use SEPA, but you're right. Most of them to some extent or another can be same day, but usually are next day. But again, because you're working with other institutions or the other intermediaries, you're working with the SWIFT network, you're working with correspondent banks, problems do occur and delays happen. And it's not beyond the realm of possibility that clients can be delayed several days on payments when doing cross-border activity. So central bank digital currencies are going to go a long way to address that issue. We're working really closely with 3 regulators across the world. We will be one of the first digital banks to implement central bank digital currencies as they become available. And we're very excited about the option of being able to settle with them, but not exclusively, because it's not a one-fit model. Some people enjoy the use of major stablecoins, and we're a big supporter. Some people will enjoy the flexibility and the government support of central bank digital currencies, but others will be concerned about the level of transparency and insight that can be afforded through those facilities. They're still not quite sure what it really means. And obviously the existing payment rails, SWIFT, SEPA, the EU specifically, are really driving forward with directives to allow instantaneous or same-day settlement. So there's great progress that's being made in central banks across the world, and it's really now about whether banks are going to catch up. Are traditional banks going to catch up to what is being presented by regulators as a way to differentiate and also become more inclusive? So one of the major initiatives, especially around banking as a service, embedded banking and payments, is to allow other parties to come into the financial services sector and not just make it about banks. And payment providers in Europe and to an extent in the US have already made some good progress, and they're just trying to find the right equilibrium between working with existing banks and also giving clients that sense of satisfaction that a payment provider can do a good job. So there is a lot of excitement, but again, it's all going to be led by the innovation banks, and a lot of the traditional banks are going to be left behind. And especially worrying for those traditional banks are the growing cost to income ratios, and we all need to keep a very close eye on some of those traditional banks.
Wow, great insights, Jason. And I appreciate what EQIBank and digital banks are doing to push the innovation forward to, sort of light a fire under these traditional banks, because, unless something like this happens, then they just move along business as usual, which it really isn't providing the best support and the best value for their customers. But because of digital banks, now all of a sudden they really need to upgrade themselves. So it's really pushing the whole financial sector forward. Thank you so much for that, and for all the insights that you've given today. For viewers that want to follow along with the updates in the banking sector and what EQIBank is doing and the different lines of products that you guys have, what is the best way to learn more about that?
Certainly. So our website is www.eqibank.com. And if anybody has any questions or queries, they can reach out to us at info@EQIBank, and we respond the same day. And our relationship managers and private bankers are available also on WhatsApp and Telegram. So we really do try and be as innovation friendly as we can, and more importantly, available for our clients.
Awesome. Thank you so much, Jason. All the best with EQIBank, and let's follow up in the near future.
Thank you, Ashton.